Hey everyone, and welcome to today's Explainer, where we are putting FMC Corporation under the microscope. Now, if you follow the agricultural sciences sector, you already know FMC. They're a historic giant. But right now, this company is sitting at the absolute epicenter of a massive corporate storm. We're talking about a really unique, kind of crazy intersection of brilliant scientific innovation, severe financial distress, sudden executive departures, and a high-stakes securities fraud lawsuit. It is basically a textbook due diligence case study. So today, we're going to unpack exactly what went wrong, what the numbers look like right now, and how the company plans to actually survive.
Okay, before we get completely lost in the weeds of corporate finance abstractions, let's just take a second to establish FMC's real-world footprint. Because we aren't talking about some small startup here. Their physical scale is massive. They operate in approximately 110 countries, and their products are fundamentally critical to growing 7 major crop types. We're talking soybeans, corn, cotton, rice, wheat. When we discuss FMC, we are literally talking about a company that helps feed the global population. Their physical footprint in the agricultural world is staggering, and honestly, that's exactly why the recent financial turbulence is sending shockwaves through the entire industry.
So here is how we are going to break this down today. First, we'll look at the agricultural sciences giant itself. Second, the class action lawsuit. Third, the 2025 financial collapse. And finally, their 2026 restructuring and M&A plans.
All right, let's jump into part 1, the agricultural sciences giant.
To really grasp the gravity of this current crisis, you first need to understand the immense value of FMC's scientific foundation. FMC positions itself as a true Tier 1 leader in crop protection. They've got nearly 6,000 employees globally, with operations on literally every inhabited continent. The backbone of all this, 5 dedicated innovation centers and 16 manufacturing sites around the world. They are an absolute powerhouse, particularly in insecticides. In fact, insecticides made up 56% of their massive $4.2 billion in revenue back in 2024. They have a rich history going all the way back to 1883, and their core mission has always been discovering and delivering really innovative crop protection solutions.
Because look, FMC's true competitive moat is its R&D pipeline. It's incredible. Take a look at that first breakthrough, Dojelex Active. This is the first new herbicide with a novel mode of action in the entire industry in over 30 decades. 30 years! That is a massive scientific breakthrough. Then you've got Isoflex for resistant weeds, their highly unique saprophyro-sprayable pheromones which actually disrupt insect mating cycles, which is wild, and fluindapyr for broad-spectrum disease control. They currently have over 35 new active ingredients in discovery and development. This pipeline is the crown jewel of FMC. It's the main reason this company retains significant underlying value, regardless of market conditions. But as we're about to see, a brilliant scientific pipeline doesn't automatically protect you from corporate turbulence.
Which brings us to part 2, the class action lawsuit.
So how did things go wrong? Well, the instability built up incredibly fast. Going into late 2023, FMC management was heavily promoting a global restructuring plan they called Project Focus. During their Q4 2023 results, they were assuring investors that new products were delivering strong results, despite what they kept calling continued destocking in the channel. But man, that narrative unraveled rapidly in the spring. On May 6, 2024, FMC reported a major Q1 revenue miss, and the stock price just plummeted. Just a few weeks later, on June 11th, the company's president and CEO, Mark A. Douglas, abruptly resigned. This sudden leadership exodus was a huge red flag to the market. It signaled that the issues ran much deeper than just simple cyclical destocking.
And all of that chaos culminated in a massive class action lawsuit filed by Cohen-Milstein. Now, as an impartial explainer, we're just reporting the claims made in these court documents, but the allegations are definitely severe. The lawsuit alleges that back in 2022, when FMC was posting record revenue, they were actually manipulating channel inventory. The core claim here is that FMC was intentionally overstocking distributors and other customers just so they could hit and sustain these inflated revenue targets. The plaintiffs are arguing that FMC actively concealed this artificial inflation from investors, and when the true state of customer liquidity and inventory was finally exposed in mid-2024, it caused a catastrophic drop in shareholder value. And the fallout from all these legal and operational challenges? It didn't just hurt the stock price, it absolutely decimated their income statement.
All right, let's get into the numbers. Part 3, the 2025 financial collapse.
This operational turbulence caused some really dramatic year-over-year revenue decay. Total revenue plummeted from roughly $4.2 billion in 2024 down to $3.4 billion in 2025. Now, North America and Latin America saw manageable single-digit percentage declines. But get this, Asia, excluding India, dropped from 848 million all the way down to 564 million. And the most shocking figure by far is India. FMC recorded a negative $421.9 million impact in India for the full year 2025. Negative. This wasn't just a sales slump. This indicates a massive systemic reversal of revenue that was previously booked or expected in that region.
So what actually happened there? Well, this data really highlights the real-world fallout of that alleged channel overstocking. According to analysis by Fitch Ratings, that massive negative revenue figure in India was driven largely by severe product return actions. Essentially, massive amounts of inventory were just shoved right back onto FMC. Combine that with the extended payment terms they were suddenly forced to offer in Latin America, and these huge intra-year fluctuations created a severe liquidity squeeze. I mean, think about it. For a company like FMC, where working capital is highly seasonal and tied directly to global growing seasons, suddenly having to absorb hundreds of millions of dollars in product returns applies immense, almost crushing pressure to an already highly leveraged balance sheet.
Now you might be wondering, was this just a broader macroeconomic issue? Was the whole agriculture sector suffering? Well, this comparison answers that pretty clearly. Fitch Ratings specifically pointed out FMC's fundamental deterioration versus its competitors. In 2025, FMC posted the absolute worst free cash flow performance in its peer set, literally dropping into negative territory. By stark contrast, a higher-rated peer like Corteva generated over $2.3 billion in positive free cash flow during that exact same period. This massive divergence pretty much proves that FMC's cash generation crisis was largely self-inflicted through one-time restructuring and severe working capital mismanagement rather than just some cyclical industry downturn.
To survive this brutal cash crunch, management had to pull a very painful lever that directly hit their shareholders. They slashed their quarterly dividend by a staggering 86%. They cut it from 58 cents a share down to just 8 cents. But that single painful decision generated approximately $250 million in annual cash savings. Fitch noted this move was absolutely necessary just to position the company to manage its restructuring costs and higher interest expenses. The goal is to hopefully lead them back to roughly break-even free cash flow by 2026. So with the dividend slashed, the CEO replaced, and a massive lawsuit pending, FMC is now in full survival and turnaround mode.
Which leads us to the final chapter. Part 4, 2026, Restructuring and M&A.
So, under the leadership of their reinstated CEO, Pierre Brondeau, FMC has laid out some incredibly aggressive operational priorities for 2026. First and foremost, they desperately need to deleverage. They're targeting a massive $1 billion debt paydown. How are they going to do it? Primarily through strategic asset sales and upfront payments from licensing agreements. Step 2 is completing the total sale of their India commercial business, which honestly makes perfect sense given that massive product return disaster they just went through over there. Step 3 is significantly lowering the manufacturing costs of their core products, and Step 4 is carefully managing the post-patent transition for one of their legacy actives, Rynoxypyr, while scrambling to grow sales of their newer, more innovative molecules. But here is the absolute most critical takeaway if you're doing due diligence on FMC right now. In their February 2026 earnings release, the board of directors officially authorized the exploration of strategic options, explicitly including, and this is a big deal, the sale of the entire company. Management clearly believes that their unique pipeline of transformative active ingredients holds significant untapped value. Value that might honestly be better realized by selling to a larger entity that actually has the capital to invest in these technologies, rather than FMC trying to slowly dig itself out of a billion-dollar debt hole all alone. So that leaves us with the ultimate question for investors and industry watchers alike. FMC possesses over a century of history and some of the most innovative, first-in-class agricultural science in the world. But they are weighed down by severe litigation, a badly damaged balance sheet, and a truly catastrophic 2025. Will this aggressive 2026 restructuring plan be enough to save FMC's independence? Or is this historic agricultural giant destined to just be absorbed by a rival? It's a fascinating corporate drama, and for sure, one you should keep watching closely. Thanks so much for joining me for this explainer, and as always, keep your eyes on the data.